All right, what's going on, Facebook? How are you? We're going to go live on YouTube as well. Just give me 1 second. My first time going live on Facebook, so this will be interesting. Hope everyone is enjoying their Friday evening, and I hope everyone had a productive week working in real estate and helping people to find new homes or new workplaces or new investments. Sorry, it's just taking a while for Facebook to go live, or for YouTube to go live. If this doesn't work, then maybe I'll just go live on the Facebook. But anyway, thanks again for checking this out. I want to discuss something that I learned, a real estate term called the equity multiple. And we'll go into what that is. And yeah, it's my first time using YouTube Live, so it's just kind of spooling up and not really doing much. It says going live. Maybe this is, I'll just have to test this out some other time. But we are live on Facebook, I believe. Thank you. And we'll give this another couple seconds. If still nothing, then it's all good. We'll just do Facebook Live. How about that? All right. So I'm just going to cut out of YouTube. That was just not working. So cutting out of YouTube. We're leaving that. Yep. See ya. Okay. Anyway, thanks for checking this out. My name is Jim. I work in real estate as a real estate agent, and I want to talk to you about a certain real estate term that I learned about on the commercial side of real estate called the equity multiple. And I'll just briefly go over this article that I found on what the equity multiple is. I'll just read you part of this article just so you get the gist of what that is and why it's important, especially when you're working with an investment property, a multifamily apartment, or some sort of maybe like a retail strip center, or some sort of a income generating property where tenants pay you rent and maybe even part of their sales. And some other fees, and you just go to your mailbox and you collect the check. So that is how real estate investing works. So I want to talk to you about the equity multiple, why it's important, and how it works in commercial real estate. And I'll include the link to this article that I'm reading in the description for this Facebook Live. But let's just jump right into it. How the equity multiple works in commercial real estate. The equity multiple is a commonly used performance metric in commercial real estate, and yet it's not widely understood. In this short article, we'll take a look at the equity multiple as it's used in commercial real estate, and we'll also walk through several examples step by step. What is the equity multiple? First of all, what exactly is the equity multiple? In commercial real estate, the equity multiple is defined as the total cash distributions received from an investment divided by the total equity invested. Here's the equity multiple formula. Equity multiple equals total cash distributions divided by total equity invested. For example, if the total equity invested into a project was $1 million and all cash distributions received from the project totaled $2.5 million, then the equity multiple would be $2.5 million divided by $1 million, or 2.5x. What does the equity multiple mean? An equity multiple less than 1x means you are getting back less cash than you invested. An equity multiple greater than 1x means you are getting back more cash than you invested. In our example above, an equity multiple of 2.5x simply means that for every $1 invested into the project, an investor is expected to get back $2.50, including the initial $1 investment. What's a good equity multiple? As always, this depends. Context is required in order to determine what a good equity multiple means. Typically, the equity multiple is most relevant when compared with other similar investments. Equity multiple pro forma example. Let's take a look at an example of how to use the equity multiple in a commercial real estate analysis. Suppose we have an acquisition that requires $4.3 million in equity, and we expect the following pro forma cash flows. And here they have big pro forma statement. I'm not going to read this whole thing to you. Like I said, I'm going to include the link to this article that I'm reading to you in the description. Okay, if we add up all the above before tax cash flows in the pro forma, then we'll end up with a total profits of $9,415,728. This results in a calculated equity multiple of $9,415,728 divided by 4.3 million which equals 2.19x. What does a 2.19x equity multiple mean? This simply means that for every $1 invested into this project, an investor is expected to get back $2.19, including the initial $1 investment. Is 2.19x a good equity multiple? As mentioned earlier, the fact that it's higher than 1x means the investor is getting back more money than initially invested. However, the equity multiple alone doesn't say anything about the timing because the equity multiple ignores the time value of money. In other words, a 2.19x equity multiple is much better if the holding period is 1 year versus 100 years. This is why the equity multiple is most relevant when compared to equity multiples of other similar investments. Equity multiple versus IRR. What's the difference between equity multiple and the internal rate of return? This is a common question since the equity multiple is often reported along with the IRR. The major difference between the IRR and the equity multiple is that they measure two different things. The IRR measures the percentage rate earned on each dollar invested for each period that it's invested. The equity multiple measures how much cash an investor will get back from a deal. The reason why these two indicators are often reported together is because they complement each other. The IRR takes into account the time value of money, while the equity multiple does not. On the other hand, the equity multiple describes the total cash an investment will return, while the IRR does not. Let's take a look at an example of how these two measures can be used together. The equity multiple is a performance metric that helps you put the IRR into perspective by sizing up the return in absolute terms. The equity multiple does this by describing how much cash an investment will return over the entire holding period. Suppose we have two potential investments with the following cash flows. And they give you the two investment charts here. As you can see, the first investment produces a 16.15% IRR, while the second investment only produces a 15.56% IRR. If we are using the IRR alone, then the choice would clearly be the first set of cash flows. However, the IRR isn't a silver bullet and doesn't always tell the full story. This can be seen by looking at the equity multiple for both investment options. Although the second potential investment has a lower IRR, it has a higher equity multiple. This means that despite a lower IRR, investment number 2 returns more cash back to the investor over the same holding period. Of course, there are other factors to consider. For example, investment 1 returns $50,000 at the end of year 1, whereas with investment 2, you have to wait 4 years to get $50,000 of cash flow. Depending on the context of these deals, this may or may not be acceptable. For example, if you plan on putting all of the cash flow from investment 1 into a checking account earning next to nothing, then perhaps investment 2 would make more sense since your cash will be invested longer. On the other hand, perhaps the cash flows from investment 2 are more uncertain, and you'd prefer the peace of mind that comes with getting half of your investment back in year 1 with investment 1. These are the issues that would be addressed in a full investment underwriting, and there are also several other metrics and qualitative factors that could be considered. With that said, the equity multiple allows you to quickly understand how much cash a project will return to the investors relative to the initial investment. It also adds some additional context to the IRR when looking at a set of cash flows to help you quickly size up an investment's absolute return potential. Conclusion: the equity multiple is commonly used in commercial real estate investment analysis. In this article, we define the equity multiple, discussed what it means, and walk through an example step by step. We also compared the equity multiple to the internal rate of return, IRR, since these two metrics are commonly reported side by side. We showed an example of how the equity multiple can add some context to the IRR by indicating an investment's absolute return potential. There you go. Hope you got some value out of that. Hope you at least got a sense of just what some of the numbers are that you'll be looking at when it comes to looking at real estate investment properties. By the way, if you haven't already downloaded your free real estate investing audiobook, do that right now. Check it out. The website where you can grab it, and it's a free download, is James K. Kim, that's me, James K. Kim commercialrealestate.info. So that URL again to grab your free real estate investing audiobook that you can listen to over and over again, maybe when you're getting ready for work, in your car, getting ready to go out. Listen to this real estate investing audiobook, which is free. Listen to this real estate investing audiobook over and over again. And that way, subconsciously, you will be learning this valuable knowledge on how you can grow your money by helping to expand affordable housing, by helping to create more jobs, by helping to generate more taxable revenue for reinvestment back into communities. Now, if you listen to this free audiobook over and over again, subconsciously your mind will learn this information, and then subconsciously you will be taking those actions to help you to become a successful real estate investor. And that's what you really want, isn't it? To be earning these checks and getting these checks in the mail every month, getting these checks into your bank account. That all you had to do was some work, look at some numbers, look at some properties, work with a good commercial real estate agent who knows what they're talking about when it comes to real estate investing, and before you know it, you have your own real estate investing business making you money and getting you checks month after month. How does that sound? So hope you enjoyed this one. As always, give this Facebook Live, or I'll also post up onto YouTube, a thumbs up, subscribe, ring that bell, follow me on Facebook, and most importantly, grab your free real estate investing audiobook now at jameskkim commercialrealestate.info. Thanks for checking this out. We'll see you next time. Bye for now.